Welcome everybody to the weekend general update for the 15th and 16th of October. Just before I get started, just a reminder that this is general advice only. You need to only act on these trading ideas if it is in keeping with your risk level and your trading plan. So just a bit of an action summary for the week. The S&P 500 index finished 6% higher, so it was a huge rally. We probably saw about 2.5% of that on Friday night. So this amazingly powerful rally continues in the US, and it's really just defying logic. But I've written in this weekend's alerts a fair bit about what I think is behind that and where we may go in the very short term. So we're massively overbought at the moment. We'll have a look at the chart in a minute. So a pullback has been likely since really the middle of last week. Whether we'll get it or not is hard to say in the next couple of days. I mean, we will get it, and the further it goes, the more significant that pullback will be. So that's why I'd like to see it fairly soon. The S&P is now sitting on a triple top formation, but the strength of this rally, it took 5 months to go from the April high to the October low, and it's taken merely 9 days to retrace half of that 5 months loss. So really just amazingly powerful. So I think the odds do favour that we will break through this triple top and run a little bit higher yet. In the short term, I'm hoping for a pullback to maybe 1167 would be a target area, and then an advance through to about 1257. So that would be a very, very tradable advance and would allow us to add to some of the long positions that we've already got. Pardon me. So the ASX 200 was lagging very badly, closed only 1% higher for the week compared to 6% on the S&P. So we're back into the old pattern of the S&P absolutely thrashing our market. We seem to have lost steam over the last couple of days. As you'll see from the chart, the ranges have got a lot smaller. But with the US continuing to power on as it is, then it's pretty hard to predict in the very short term on a day-to-day basis. Gold closed $43 higher for the week, and as we'll see, I think is still in a consolidation pattern and may do so for several more months. And silver is was about $1 higher on the week, so it's pretty much doing the same thing. So we'll just have a quick look at the strategy before we move on to the charts. It hasn't changed a great deal, although with the stocks, I guess I'm looking now to stand aside on shorts for a little while. So looking at staying with the current long positions and reducing short exposure on a pullback in the next few days if we get it. So we've got a few short positions open. They're a little bit in the red, so if the market does pull back, that will give us an opportunity to get out around about break even, just leaving us then with some long positions. When it comes to gold and silver, because I think they're still just basing, I'm in no hurry to add to our precious metals ETFs exposure at this stage. I think we'll just pick off the dips that we will probably get in coming days or weeks. And with respect to the gold producers, it's really the only place I want to consider doing any buying at the moment. Just looking at progressively adding to those positions when the market does pull back with pretty wide exits. So that was the same as last week. So let's have a look at some charts, and we'll start with the S&P 500. There is one of two scenarios playing out here. One is that we are at a very similar point to where we were in 2008. I'll just pan this back. I know this will make the chart look a little bit messy, but just to make my point. So 2008, we'd had a significant run up, and then we started to get, we got a progressive weakening of the market, which started in, just get a date on that, started in October of 07 was the highs. We then got a series of lower highs and lower lows. You'll notice the red 50-day moving average had cut through the 150-day shortly after that, and then the 150 day, the green line, also turned over, and that was around about January of 2008. It then took another 6-7 months before the market worked lower over the first half of 2010, and tried to rally a couple of times, and then we got into this serious decline to the downside in the GFC. That is still a possibility, and if you fast forward to where we are now, you can see that the red line, the red moving average, the 50-day, has clearly cut through the 150. The 150 has rolled over, so if this was to be the same as 2008, then that would put us around about this point here, perhaps a little lower, perhaps around about this point here. So if we are to play out in the way that we did in 2008 with another serious decline ahead, then that's about where we're positioned. However, as opposed to 2008, where they let Lehman Brothers go, they denied that there was a problem through the first half of 2008, and there wasn't a great deal of money printing happening at that stage, and the market eventually fell apart. We fast forward to where we are now, and we now have a much greater awareness of the looming problem in Europe than we had in 2008. We have an enormous amount of money printing occurring, so it's entirely possible that we will see the markets head higher in a fashion that we've seen several times before, particularly back in the 1990s, when there was significant stimulus put into financial markets. So that's entirely possible as well. I tend to think we're going to see one or the other. I don't think we're going to get some kind of mild middle ground. I think we'll either get a severe correction because politicians in Europe just get it completely wrong and the market just really falls apart, and there are many triggers that could do that. Certainly Greece defaulting, causing a domino effect, with Italy then defaulting, would then see financial stocks around the world pretty much smashed. So that's a distinct possibility. The other possibility, though, is that the amount of massive money printing and liquidity that's injected into the system completely overwhelms that scenario, and we actually are at a position similar to where we were in early 2009, perhaps towards the middle of 2009, and we're about to start a very powerful rally to the upside, and you can certainly make a case for that at the moment. So that's the bigger picture, and for me, the proof that that would be the case, we'd probably need to be getting up above 1350 for me to start to believe that that scenario was in play. I think the more likely one at the moment, the one that I can feel a little more comfortable with, is, you can see here we've had a possible C-leg completion to the downside. We've now got a triple top formed from these points here, which was the 1st of September, around about mid-September, and again now. We could get a push up to this 1257 mark that I've been highlighting now for some time, which would be the 61.8% retracement of this whole move down from April, and so I think that's a potentially likely scenario, and then a bit more of a sell-off then. But I think in the short term, that's what I'm looking for, a pullback to maybe 1167. If it doesn't get to there, then that would indicate strength, and if we do break this top formation here, then I would expect that 1257 is probably a given. So that's it for the S&P. Let's have a look at the Australian market, and you can see we've just in the last week we have broken this downtrending channel that had been in progress since April, but you can equally see that as soon as it got outside that trend channel, that the daily ranges have really shortened up, and we're starting to get closes well off the highs, whereas if you look at when this started, 5th, 6th, 7th of October, the candles were much more powerful than they are now. So we'll just have to wait and see over the next coming days, and it will depend to a degree on the S&P. Let's have a look at silver and gold. So silver, we've had a significant pullback. We got down to these lows down here at 26.50, and I believe that we're probably just forming a base around about this level, probably between $28, $29 and maybe 33, and that could take quite a few more months to actually play out. This is gold, so if we pan back and have a look, the market had been running, it's been running incredibly hard since November of 2008. That's about 34 months, almost 35 months at this stage, with a final massive run up that got way ahead of the moving averages. So to correct a 34-month run, it doesn't seem consistent with me that this correction will play out in just a few short weeks. I think for that reason we could see 3, 4, 5 months of basically a basing formation. So looking to get into exposure directly to gold and silver. I think on the dips, I'd certainly be buying any significant dips in price. Now the gold producers, the actual stocks themselves, don't necessarily need to follow this same pattern because they are already extremely cheap and lagging the price of gold considerably. So I don't see any reason why gold stocks cannot go up, even though gold itself is not rising. So need to draw that distinction between those two. So in terms of the week ahead, I would expect obviously our market will open fairly strongly on Monday. I'm really hoping that we get a pullback in the US market for at least a few days next week to wash out some of this excess. That will give us an opportunity to get out of some of the short positions that we're in and add to some of the long positions that we're in as well. So that's it for this week. We'll talk to you again next weekend. Cheers.